2014 marks the centennial anniversary of the Federal Reserve Bank of Minneapolis. In recognition, Bank President Narayana Kocherlakota is meeting with citizens in every state in the 9th District. On May 13th, he took questions from students while visiting Eastview High School in Apple Valley, Minnesota.
How do you feel about the balance between the inflation rate and the unemployment rate, and the Fed's obligation to keep inflation rates down at the same time, make sure unemployment is low?
You know, I think this is really important for us to have the, so dual mandate set by Congress, so Congress has established our goals as the Federal Reserve. We're a creature of Congress. And so whatever they decide our goal should be, I'll work within that framework. With that said, I've always felt that the fact that we have these two goals makes us more honest about what our objectives are than other central banks. So if you look around the world, most central banks only have the one goal of inflation. But if you read what they actually do, they'll say, well, we're going to put some weight on economic activity as well in determining how long it takes us to get back to our inflation target. We're very clear. I mean, the dual mandate makes it clear that we're putting weight on both inflation and economic activity and on unemployment. So I think that's a very, very positive thing from that point of view. The other thing I'll say is that inflation is, talking to people about having inflation running at 1% or 1.5% and explaining to them that's a problem is hard. People generally think, boy, having high inflation is a real problem for me. Having prices go up rapidly, that's a problem for me in my life. So why are you, the central bankers, saying you want to have a higher inflation? The second mandate actually makes it easier for you to explain that to people, because usually when inflation is running below target, running below our goal of 2%, unemployment's too high, as is true right now. Much easier to talk to people about unemployment being too high as being a problem. They get that immediately. So, you know, throughout my career in the Fed, there's not been a tension between these two goals. And so it's just, I think, been helpful really to have them support each other the way we have it.
So I understood that you worked at various institutions before coming to the Fed. So what made you take that leap from professor to president?
Yeah, a lot of people ask me that. What? Absolutely not salary, actually. Yeah, no, it's a job. I often joke it's a job where I'm getting paid less, but surprising. But the good news is I work a lot more. So, no, I did it because of, if I had been asked about doing this job in 2005, I would have said that it's an interesting job, but it's pretty well understood how to do monetary policy, so I wouldn't have been as interested in doing it. What changed my mind about it was in the financial crisis in 2008. We had the financial crisis and the resulting recession, and I did an interview for National Public Radio. So the way these interviews work is they ask you tons of questions over like 60 minutes. And they only use 30 seconds, right? So, but one of the questions the guy asked me was, what are your feelings right now? This is like October of 2008. So all the bad things happened in September of 2008. Banks are failing. The government is taking extraordinary actions to try to keep the banking system afloat. And I said, I really want to be of help. I want to be of service. I want to be of use. And the image I had in my mind was the Manhattan Project, the A-bomb project, where all the scientists got together physicists gave up gave up what they were doing in their everyday life to help with the United States with it in its hour of need. And I had the same feeling about, I was trained in a particular way, and I felt that what my training and what I'd learned could be of use. And then this opportunity came along where the president of the Minneapolis Fed was retiring, and so I didn't even have to move to be able to do this. So that's why I was willing to make the leap from professor to policymaker. Is just I saw a lot of questions. I certainly didn't know the answers to them. I don't want to pretend for a second that I thought I did, but I did think I had a way of thinking about things that could be of use.
What are your thoughts on Bitcoin, and do you see decentralized currencies as a viable option at all in the future?
Everyone wants to know about Bitcoin. You know, so I'm the president of the Federal Reserve Bank of Minneapolis, and so one of the things I think that means is that you know, I'm pro U.S. dollar. No, but in a more serious vein, I think that there's really a lot of interesting things happening in what we broadly call the payment system. Just having people be able to make, how people make payments to one another in exchange for goods and services is changing very rapidly, and Bitcoin is an interesting example of that. I'm not sure that, I'm still learning about it, to be totally honest. I find the payments aspect of it more interesting, or as interesting as the currency part. So the idea that people are making exchanges through this system of a virtual account for goods and services. But you need someone to be able going, the thing that always seemed hard about that is someone has to check to make sure that this is all being done in a kosher way, and that you're not exhausting your account in some fashion. And the Bitcoin way of checking for that is pretty interesting and pretty cool. So I remain interested. I think it's interesting. I think there's going to be a lot of entrance into this area, and so saying Bitcoin's going to be the winner, that would be very premature to say that. But I think there's just a lot of very interesting work going on in payments right now, and it's probably going to change tremendously over the next 10 years.
Knowing what you know now, what would you do differently in your post-secondary decisions that would help you, that you do differently to help you get to your career path that you are in right now?
So that's a really good question, and it's a question that I don't think that way. And what I mean by that is I'm always very forward-looking. I don't really think about what could I have done differently. And I sort of gave it up almost deliberately at a certain point where I said, I'm not going to think like that because I want to think only about what should I be doing in the future as opposed to worrying about what I can't change in the past. So I understand why you're asking the question. It's a very good question, but it's a very hard one for me to answer. I guess the only thing I'd say is not to think about, I would encourage you not to think about your decisions that way. And what do I mean by that is, I think you should think about your decisions in terms of the good things and the bad things they might provide, but not in terms of, if I don't take this course, I'm going to regret it for the rest of my life kind of thing. Because I think regrets end up, you know, that's not an emotion you should be spending a lot of time on. I realize I'm not answering your question. I'm sorry.
If I understand the U Chicago right, where you went to school, there are going to be more rational expectations where if we know that the interest rates are going to go up or down, we'll act to cancel that out. And now with monetary policy, you are acting to change interest rates. How does that all fit together?
So I think that so first of all, I'll say a couple things. I think Chicago is certainly rational expectations was a really important part of the way Chicago economists thought about the world. But it's an intensely empirical school. If you had to describe more what the heart of Chicago economics is about, it's really about empirics, and that's what I think drove people's thinking and approach to economics. In terms of how you make sense in a rational expectations world of interest rates mattering, it really is about, well, I'll say two things. One is inflation expectations tend to be pretty sticky compared to what you might think they are in a truly rational world, and that gives monetary policy power immediately because we're able to move the nominal interest rate around. And then what matters to people's decision making is the real interest rate. So it's the nominal minus expected inflation is what matters. So if expected inflation is not moving very much, if that's well anchored, then that immediately gives us some ability to influence the real side of the economy. That's a non-rational expectations view. The other view, which is related, it comes down to, it's a deeper model of why inflation expectations don't move around very much, is that both prices and wages are very slow to adjust. So even if people's expectations are fully rational, the fact that prices and wages don't move very rapidly, that can also give monetary policy the ability to influence the economy. Is that making sense? I mean,
Well, you grew up in a really diverse environment. How has that diversity helped you throughout your career and in your current position right now?
Yeah, so my mom was of European descent, and my dad was of Indian descent. And so it's Indian descent. He was from India. So I was exposed to lots of different ways of thinking about issues immediately. Actually, even growing up in Canada, I mean, Americans always snicker when I say this, but actually Canada's different too. So there's also even a Canadian way of thinking about things that was interesting to be exposed to. I just think that's really valuable in today's environment, in today's world, where we live in a very diverse society. It's getting increasingly diverse, and it's important to realize that people don't always come to problems and issues from the same perspective. And that comes up in thinking about the answers to problems. It's good to draw on lots of different sources, but also comes up in the communication end, that the way you talk to people about what you're trying to communicate, how you try to communicate will depend on where people are coming from, what their background is. And you know, I think coming from a diverse background is helping me with that. Of course, it's impossible to know what the counterfactual is. But I think it's been useful along those lines.
How do you think raising of the minimum wage would affect the state of the economy?
So this is a great question, and it's a great question because it just shows how much economics has been transformed in the last 30 years. So when I went to college in 1979, the one thing you were taught is that the minimum wage was a bad thing, and raising the minimum wage had unambiguously bad effects on unemployment in particular. So you would see that diagram, the X, right, the cross, and then you would draw a little floor, and you'd say, hey, there's a gap now being created by that because there are certain people who can't make contracts with one another. So that was the theory, and that was in place. The big change in economics is that we're no longer so much of a theory-driven field. We're much more empirical than we were in 1979, and it's because we just didn't have the data in 1979. And now it's, just the data that's been opened up to us is just remarkable. So in the mid-90s, David Card, who was an economist at Princeton or Berkeley at that point in time, and Alan Kruger, who was at Princeton, did a very nice a piece of econometric analysis, a natural experiment, which showed that at least in the situation they were studying, a small increase in the minimum wage could actually increase employment. Totally different from the little X in the line. And that experiment, or that econometric analysis, had a huge impact on people's thinking. You know, I think it's still a general agreement that if you raise the minimum wage to $100 an hour, that would be a very bad thing. But I think what's less clear is the kind of minimum wage increase that's under contemplation here, that was undertaken here in Minnesota, or is under contemplation at the federal level. It's less clear about whether that will have an increase employment or decrease employment. And that, you know, and the reason why you might think that increase in wage, it sounds counterintuitive. Why would increase in wage actually increase employment? It's because if you think of firms actually having a lot of market power in their interactions with workers, workers might be not working because the firms have driven the wages so far down. And increase the minimum wage might draw people into the workforce that otherwise wouldn't work. So that's just the theory argument. But it depends then on putting numbers behind all that. So that's been what I like about this question is, it really indicates how my field, how economics has changed. It's no longer as deductive a field. We used to be, here's what we assume, and here's what we get out of what we assume. And it's just become much more data-oriented than it was 30 years ago. That's just been a real positive thing.
Why do you think that the United States has come out of the financial crisis better than the Eurozone has? And do you think that the policies of their respective central banks had anything to do with their recoveries? I
think the Eurozone has faced a lot of challenges. the heterogeneity, in fact, they have all these different countries with different kinds of circumstances, has made their problem, I think, more challenging for them. So I think that between Germany and the United States, it would be hard to I think both those countries have done, I mean, if you're grading on a curve, we've done well. If you're grading absolutely, I would argue that we both have faced challenges. But yeah, you look at a country like Spain, trying to follow the same monetary policy for a country like Spain as you do for Germany. I think that's going to impose a lot of costs on the outcomes, and that's the situation they've faced. I think that I think the ECB has not been as aggressive in some of their monetary policy choices as we have been. They face different kinds of restrictions and different kinds of laws governing what they see themselves being able to do. I think monetary policy has helped in this country, but it's always hard when you look at an outcome in the macroeconomic perspective. There's always the treatment you're following and then the shocks that are hitting you, and sorting out, is it because do we do better because the shock wasn't as severe, or because we did a better job of confronting it, is always very hard. I wouldn't want to. I'm hoping there's not some French policymaker talking to French high school students about how bad a job we did in the American monetary policy. So I don't like criticizing other countries.
You mentioned that book on income inequality. What's your views on that in the United States today?
I think it's there's just been the evolution of income inequality in this country is something that policymakers should be thinking about. I don't know what the conclusion of that thinking should be. So we just issued our annual report out of the Minneapolis Fed, and so what that report focused on is what's happening for the people who are in the bottom fifth of the income distribution relative to everyone else. And there you see growing inequality. A lot of the policy conversation is about the fact that the top 1% has been earning, their income has grown so much more than the people in the bottom 99%. Those top conversations are about totally different things, I think, in my view. I think the conversation about the bottom fifth versus the top 4/5 is probably much more about education, about trying to get people better opportunities and taking advantage of those opportunities. I think the conversation about the top 1% is about other things. It's hard, I think, to make the argument that inequality between the top 1% and the bottom 99% is driven by difference in education. In fact, you can look at the data and you'll see it's not driven by that. So I think it's really important to try to keep that conversation as fact-based as possible, and try to relate it back to the drivers of the things we're talking about. Ultimately, I think that what should matter for us as a society is after tax and after transfer income inequality. In principle, there's nothing wrong with people earning different incomes for doing different things. The real question is, how do we want to deal with that as a society? Do we want to transfer from the people who earned a lot to the people who earned less, or not? And how much of that do we want to do? That's not so much of a question for economists. That's really more, well, for us as citizens, it's really more a question for us.